Well, hi everyone, and welcome to the Lucky Finance channel. Thank you for subscribing if you already have, and if you haven't, please hit the subscribe and the like button and also the bell icon so you can get informed on future videos. So today is a very interesting topic. I'm going to compare Facebook and Google. These are obviously leaders in their fields, but the question is which one could be a better investment over the next 5 years? So stay tuned as we go through this very important discussion. I just want to start again by the disclaimer. I'm not a financial advisor, and any information that you see in this video is purely for informational purposes only. Please consult your own financial advisor. Investing in stocks is risky, and you need to fully understand the risks that are involved. What I'm here to do today is provide you with information that you can take, do your own research, convert that to knowledge, and eventually wisdom. Some of you who have seen my past videos are familiar that this is a simple 6-step process. So typically we review the earnings and dividends for the current year in step 1. Then in step 2, we look at the estimated 5-year growth rates for earnings and dividends. In step 3, we review the PE ratios and the PEG ratio, which is the price to earnings ratio or the price to earnings growth ratio. And then in step 4, we do some simple calculations to calculate the earnings and dividends 5 years from now. And then in step 5, we estimate the future stock price in 5 years. And then finally in step 6, we set some kind of a target buy price. So this technique works well for Facebook and Google since both companies have had a history of earnings. And I will take you through these steps in more detail. So step 1, the current earnings and dividends. And again, this is from seekingalpha.com. For 2020, Facebook's earnings per share are $7.27, and Google's earnings per share actually came down a little because of COVID impact to about $42.65. Those are still humongous numbers. Now, interestingly, both companies are high growth companies and they don't pay any dividends. So you can see the dividends per share for both companies is essentially 0. Okay. On step 2, we now look at the 5-year earnings and the dividend growth rate. And this is from vs.Google. And you can see Facebook has a really high 5-year growth rate estimate of 16.37% for the earnings growth. Google's about half that, 7.69%. And since they don't pay dividends, there's really no dividend growth rate for both companies. Now that could change in the future. It's certainly possible for Google to pay some kind of dividend growth and even Facebook to pay some kind of dividend growth. So this is something you got to keep an eye on and probably check once a year or so. But right now there are no dividends, and so there's no dividend growth for both companies. The next step is to look at the PE and the PEG ratios. So currently the PE ratio for Facebook is about 32 and the PE ratio for Google is about 31, so quite similar. If you look at the PEG ratio, which is the PE ratio divided by the earnings growth, you're looking at about 1.95 for Facebook, which is on the high side, and 4.03 for Google, which is actually very high. Okay. In step 4 now, we start to look at calculating the earnings and dividends over the next 5 years. And it's again a simple calculation. For the earnings, you take the 2020 earnings and then you multiply it by 1 plus the earnings growth rate divided by 100, whole raised to the power of 5 because we're looking at this 5 years from now. And a similar calculation for the dividend growth rate. So if you do that for Facebook, you get an earnings in 5 years of $15.15. And for Google, you get $61.77 5 years from now. Since they don't have dividends, there's really no dividends in 5 years, and that's the assumption we're making. And as I said previously, that could change. So it's possible for these companies to pay dividends in the future. Let's calculate the 5-year stock estimator. This is the fun part. So what we do here is basically we take the earnings, multiply that with the dividends, and then we multiply it by the current PE ratio, and then we assign a fair value PEG ratio. Now, the fair value PEG ratio for typical growth companies like Facebook would be about 1.5, and for Google would be a little lower, about 1.2. Companies with a PEG ratio of between 1.5 and 2 would be the very high growth companies, like some of these companies that have just gone public. I wouldn't invest in companies that typically have a PEG ratio above 2 in my calculation. So also I would not invest in companies that have a PEG ratio less than 0.5 or half. So if you do that calculation, you get a pretty strong number for Facebook, $744 a stock price 5 years from now. And Google, you get a price of $2,297. The current price of these companies, Facebook is $230, Google is $1,438. This is as of June 7th. So potentially, if you invested at $230 and the price goes up to $744, that's a 223% return in 5 years, or a 44% annual return for Facebook, which is very strong. For Google, if you invested at $14.38 and the price went up to $22.97, that would be a 60% return in 5 years, or a 12% annual return, which is not bad. So step 6 is, what do you set as your target buy price? Now, both companies are leaders in their fields, but just from the calculations, it looks like Facebook is better positioned from a stock perspective, mostly driven by higher earnings growth and also a higher PEG ratio that we assigned of 1.5 versus 1.2 for Google. So at the current price of $230, Facebook definitely seems still to be a relative bargain, potentially returning a 44% annual return over the next 5 years. But at current prices, Google could return about 12% annually, and perhaps you should look for a slightly better entry point. So what would be a better entry point? I think if you wanted to generate a 20% return on Google for the next 5 years, a good entry point would be somewhere in the range of $1,150 roughly. And the way you calculate that is you take the 5-year stock price and you divide it by 1 plus the return you want to make over 5 years multiplied by 5. And you get that number. So for Google, I would wait a little bit. Some of the risks to consider, this is really important. Both companies are facing a number of challenges and risks. I've listed a few of them here, there's even more. For Facebook, some of the challenges really are, how do they continue to keep the younger generation interested in their app? I think a lot of the younger folks are moving away from Facebook, but interestingly, a lot of them have moved to Instagram, which is also part of the Facebook portfolio. So it's not like they have left Facebook. Some of them, of course, have gone to other applications like Snap, etc. The other thing that's happening is, how does Facebook maneuver the current political situation? As probably most of you know, a number of people are looking to boycott Facebook and all of its apps, since they associate what Facebook is doing with supporting the Trump government in the recent turmoil over the George Floyd situation. And that's something you need to think through and decide for yourself. Facebook has some really amazing products, Instagram and WhatsApp, for example, but they're not really monetizing it very much. So how do they convert this into money-making machines? Also, you may have heard Facebook wants to offer a cryptocurrency called Libra. And the question is, how do they grow in that space? That could be very interesting in the next few years. I think the most important thing for Facebook, the biggest challenge is, I think the management team is not very mature, and they still are very dependent on Mark Zuckerberg and the decisions that he makes only at the top. I feel that Facebook could really benefit from a much stronger and much more mature management team, and I think convert into some of the stock prices that I'm predicting. For Google, there's also a number of challenges. The biggest one is how not to be seen as a monopoly and really incur the wrath and the ire of countries, peoples, and governments. It's almost, every month or two I check on the internet and I find that some country, some government is penalizing Google with a huge fine, $1 billion fine for being considered as a monopoly. That's a problem. How does Google remain close to its roots? Some of you may remember when Google started, their goal was to be good. But currently, when their current focus is on growing wealth and stealing your private information and selling that, that's not very good. So how do they change their culture? How do they stop collecting your private information and selling that, which is really their primary source of growth? And then everybody knows YouTube is fantastic. We all love YouTube, but how does Google monetize YouTube and make more money with YouTube? Also, there are several other brands within the company. For example, their health initiative, I should say, It's Verily, they haven't really done much with it. Over 95% of Google's revenue still comes from the internet and the Chrome and the Google Internet brand. And also Google has wasted a lot of money on some pretty useless ideas that have gone nowhere. So how do they pull back all of those wasted investments and stop investing and focus just on 3 or 4 good ideas that can help them grow? So those are some of the challenges to consider for both Facebook and Google. In conclusion, I don't think you can go wrong buying into either of these companies, Facebook or Google. Both, I think, are good investments and are cash generating machines. If you invest at current prices, you will still make money on both. But for Google, I would wait for a better entry point, maybe somewhere between $1,100 and $1,200 to get a 20% annual return. The stock did go as low as close to $1,000 during the March COVID situation. It's certainly possible that it could get back into the $1,200 region if the market decides to release some of the hot air that it currently has. So keep an eye on that. Definitely keep an eye on how these companies are navigating through the challenges that they face, and if they are putting in place the right mature management. But the bottom line is both these are well-entrenched companies and both of them are leaders, and you can't go wrong in either of them. But my pick at today's prices would be Facebook. Thank you. And once again, a reminder, if you like this video, please hit the like button, please subscribe, and also hit the bell icon. I will try to post a video every week or so. Thank you for your time. Bye.